Hi friends, welcome to Ask Investment Academy YouTube channel.
In this video, I will try to give as much as information about IPO. If you are yet to subscribe to my YouTube channel, please subscribe immediately and click on the notification symbol to get instant updates on our new stock market awareness videos. In this video, I will explain about IPO and why IPOs are having great demand among the investors. Next, I will explain on what factors you have to decide whether to apply for IPO or not and how to apply. Then you have to understand what are the various categories of IPO and the allotment criteria in each of these categories. Then you have to know on what basis this IPO listing gains depends, and here you have to understand important concept called grey market premium and co-stock. Next, I will tell you how to book profits at better listing gains. Then you have to know after exiting the IPO with profits how much tax you have to pay. Then you have to understand what are the refund and cancellation rules. Next, I will cover mistakes to avoid and tricks used to get more IPO lots. Before understanding about IPO, first you have to understand what is a primary market and secondary market. In primary market, shares are exchanged between the company and people. In secondary market, shares are exchanged among the people itself. Normal buying and selling of shares in the market are called as secondary market trading, and companies sell the shares initially to the public in primary market through initial public offering, shortly IPO. Generally, companies choose IPO to raise capital for their business expansion, or they will choose IPO to avoid paying huge interest rates to banks for the loans which they have taken earlier, or for gaining fame and reputation after listing in the stock market. Why IPOs are having greater demand among the investors means due to the huge listing gains. For example, in September 2020, Happiest Minds IPO opened with a listing gains of 120% and increased to 150% on the same day itself. IPOs are of two types. First one is fixed price issue and second one is book building issue. In fixed price issue, companies sell shares at fixed price known to investors well in advance. In book building issue, companies sell shares in a price band between upper price limit called as cap price and lower price limit called as floor price. For book building issue, investors has to bid for IPO within this price range. Not all IPOs will give good listing gains. Some will open with a discount, that means listing loss also. For example, in October 2020, Angel Broking IPO opened with a listing loss, that means discount of 10%. There are some important factors based on which you have to decide whether to apply for IPO or not. Before applying for the IPO, first try to understand the business model, products and the services offered by the IPO company. Fundamentals and the profit growth over the past few years has to be checked. Verify the background of the people who are in the top management of the IPO company. Check the competitors' future growth prospectus and the parental company analysis. What is a parental company? For example, if SBI Cards IPO is there, SBI is the parental company. So you have to understand fundamentals of the SBI if you plan to apply for SBI Cards. Next, try to predict market sentiments and the direction on the listing day. If you predict market sentiments are weak on the listing day, then don't apply for that IPO. Generally, already listed companies regularly informs to the stock exchange about their results, profits and balance sheets. IPO investors will not have such kind of information for unlisted companies which are planning to go for IPO. So Sbi asked for a document called as Draft Red Herring Prospectus, shortly DRHP document from the company seeking for IPO. Sbi goes through this DRHP document which contains history of the company, when it was incorporated, business carried out, customers, balance sheets and the profit and loss statement for the past 5 years. It also contains how much capital they are planning to raise through the IPO, the projects in which they are planning to use this capital raised through IPO, promoters' shareholdings, companies and the projects of the promoters. Everything will be listed in the Draft Red Herring Prospectus. Sbi goes through all this information, verifies these details and seeks for clarifications if required. If everything seems okay, then SEBI will give approval for the draft red herring prospectus and allows the company to go for IPO. After going through draft red herring prospectus document, you decided to buy IPO. Now you need to know how to apply for it. You have to apply in the multiples of lot sizes in between issue open date and closing date. You can apply IPO from net banking or UPI or from bank directly. Whatever money you plan to invest while applying, that much money will be blocked till allotment. Now I will explain you how to apply IPO from SBI Net Banking. After logging into SBI Net Banking website, click on the e-services tab, then click on the DMAT and ASBA link. Then click on the IPO and select the IPO in which you are planning to apply. Then enter your personal details like name, PAN card details, BOID of your DMAT account and place your bid in the issue price range. Now you have successfully applied for IPO. Next, allotment of lots varies from one category of investors to other category. There are basically 4 categories of investors in IPO. They are: first one, qualified institutional buyers, shortly QIBs. Second one, high net worth investors, shortly HNIs or non-institutional investors, shortly NIIs. Third one, retail investors, and fourth one, employees. First, try to understand about these categories. Qualified institutional buyers QIBs are investment organizations which offer services like mutual funds, pension funds, provident funds, and insurances. QIB firms apply IPOs with huge capital. As per the SEBI rule, QIB reservations in entire IPO shares should not be more than 50%. Next category of IPO investors are high net worth investors, HNI. They are also called as non-institutional investors, NII. HNIs are the normal people who apply IPO stocks worth more than 2 lakhs. These HNI investors has a reservation of minimum 15% stocks in total IPO value. Next important category is retail investors. Retail investors are the normal investors who apply IPO worth less than 2 lakhs. Retail investors has a reservation of minimum 35% shares out of total IPO worth. Some IPO companies reserve some of their shares to the employees. This category is called employees category, which is around 1% of the total IPO shares. Exact percentage of these reservations of each category is decided by the IPO company and has to be approved by the SEBI. Now you have to understand allotment criteria for each of these categories. If IPO is undersubscribed, then everyone will get full lots as per their application. If IPO is oversubscribed, then each of these categories have different IPO allotment criteria. First, we will see allotment criteria for retail investors whose investment is less than 2 lakhs. If number of applicants are less than number of lots allotted for retail investors, then each and every applicant will get 1 lot. And remaining lots are allotted proportionally to the people depending upon the number of lots applied. If number of applicants are more than number of lots allotted to retail investors category, then allotting 1 lot to each and every applicant will not be possible. So in this case, allotment is based on automated lottery system with maximum 1 lot per applicant irrespective of the lots applied by the retail investor. In case of HNIs, lots are allotted proportionally. Number of lots allotted for each HNI is calculated by total number of lots applied by an HNI investor divided by subscription in HNI category. Qualified institutional buyers also get their allotment on proportional basis similar to HNIs. After the shares allotted to the investors, it takes maximum of 7 days for the company to get listed in the stock exchange. Till now you understood what is an IPO, factors to decide whether to apply for IPO or not, how to apply and allotment criteria in each category. Now, how to know whether you got IPO shares allotted or not? For knowing your allotment status, go to BSE India website by searching in the Google and enter all the details asked by the BSE website and check whether your IPO shares are allotted to you or not. Now, say for example, IPO shares are allotted to you. Now main question arises in your mind. What is that question? With how much listing gains your IPO will list in the exchange? These listing gains depends upon company fundamentals, future growth prospectus, oversubscription, market sentiments, and movement on the listing day. Not only these things, your grey market and grey market premium plays a major role in the listing gains. Now try to understand what is a grey market and grey market premium. Grey market is unofficial market where unofficial deals happens outside the exchange and demat accounts. Grey market transactions happens between the people who applied IPO and the people who did not apply IPO. In grey market, IPO applicants can sell their IPO lots before allotment and listing itself. Grey market transactions happens at certain fixed price called as Kostak by adding some profit called as grey market premium. So, price at which IPO applicants sell their IPO shares is called as Kostak price, which is equal to IPO bid price plus grey market premium. Now, let me give one small example to explain how trades happens in grey market premium. If an IPO investor applies 10 lots at 10,000 rupees per lot, so total 1 lakh rupees will be blocked for IPO investor. Now, if he don't want to take risk till listing day, he can make unofficial agreement with others like he wants to sell his IPO shares at some profit, say 20%. So in this case, amount blocked for IPO investor is 1 lakh and remaining 20,000 is grey market premium. Here, total 1,20,000 is Kostak price at which IPO applicant sells his IPO application. If IPO applicant gets 5 lots allotted out of the 10 lots which he applied, and if the stock has a grey market premium of 50% on the listing day, then it will open with a listing gain of 50%. Then IPO applicant has to pay remaining 30% profit to the person with whom he made agreement in the grey market. So why there are some people who are ready to buy IPOs in the grey market instead of buying in the normal market? If they buy in the normal market, they can get all 50% listing gains, right? Then why they are buying in the grey market for lesser profits? There might be the many reasons. They might not have enough money to apply for IPO in the issue dates, or they might not want their money blocked in the IPO application. So they will buy in the grey market. Here, what is the risk for the buyers in the grey market? If grey market premium falls or if IPO lists with the loss instead of gain, then they have to pay that money to people who sells those IPO lots in grey market. Now try to understand how to book more profits at better listing gains. All IPO stocks are available for trading in the secondary market on the listing day at 10 am. Everyone will buy IPOs for the listing gains only. So generally, IPO stock price falls immediately after listing. If it sustains at the listing price till 11 am, then apply technical analysis strategies and indicators on 5 minutes time frame candlestick chart pattern. For learning all these entry exit strategies, technical analysis, money management and trading psychology to get 90% accuracy in trading, then join our Ask Investment Academy Telegram channel with link shared in the description. Now imagine you have got very much good profits in IPO. Now how much tax you have to pay for IPO gains? IPO gains are considered as STCG gains if you book profits within 1 year of the listing. If you want to learn about STCG and LTCG tax, please see my video on the taxes by clicking on the link given in the description. If your total personal income including IPO gains is less than 2.5 lakhs, then no need to pay any tax. If you fall in any of the income tax slab and if you sell IPO stocks within 1 year, then you have to pay STCG tax of 15% and 4% cess. If you apply IPO through net banking, then it will take 1 or 2 days after the allotment to get refund of the blocked money. If you applied through UPI, it might take 7 days to get refund. If you want to cancel your IPO application, then you have to cancel before issue closing date and closing time. Now try to understand the common mistakes that you have to avoid while applying IPO. Applying the same IPO from your personal different demat accounts leads to rejection. Applying from personal or others net banking accounts is okay, there is no issue. But if you are applying through the UPI, then compulsorily you have to apply from your personal UPI account only. Otherwise, your IPO application will get rejected. If you want to get more lots in IPO, then apply from friends and family demat accounts rather than applying all lots from the single demat account. If you like my video, please subscribe to my YouTube channel and click on the notifications bell icon to get instant updates on our new stock market awareness videos. Please like, share and comment. Thank you very much.